Ladies and gentlemen, this is an urgent, critical message to all investors. We just got two new reports that are very, very worrying. Right now, we're continuing to see US bank deposits completely plummet, and we got the Federal Reserve who spoke at Jackson Hole on Friday evening. He's come out and warned that there could be more rate hikes coming, and rates are going to be higher for much longer than the markets are expecting. And on top of all of this, mortgage rates have hit their highest level since 2001, or 7.25%. So simply the economy and the middle class can't take it anymore. So everyone, we've got so much to cover in today's video, so let's not waste any time. Let's get straight into the news, the facts, and the data. Well, first things first, look at this, everyone. US banks deposits are plunged last week as Fed rescue funding usage hits new record high. So what this report is, it's a report of bank deposits that come out every single week. And just over the past week, we've seen nearly $50 billion withdrawn out of the banks. Now, on top of this, what the Federal Reserve did to save the banks during the March banking crisis is they created a new facility so the banks could borrow from the Federal Reserve, but that's going to expire in 6 months and they're going to have to pay back hundreds of billions of dollars. So let's hit the charts, everyone. So look at this chart, everyone. The usage of the Fed's emergency fund rose yet again by 144 million to a new record high. Now let's look at the next chart here. We can see total bank deposits on a seasonally adjusted basis fell for the second week in a row, plunging last week by 49 billion. So again, everyone, this is very, very worrying. And this facility is called the Bank Term Funding Facility, and this expires in 6 months. So if the banks don't find a solution by then, or if deposits keep on being withdrawn and we continue to see bond yields rise, we're going to see more issues for the banks in just a matter of months. Now, what the markets are all hoping on to save the banks and to save the stock market and the financial markets is that the Federal Reserve will pivot soon. He'll start cutting interest rates, and why I definitely think that's a possibility early next year, the Federal Reserve has come out and said there could be more rate hikes coming and there won't be any rate cuts anytime soon. Look at this, everyone. Fed Chair Jerome Powell calls inflation too high and warns that we are prepared to raise rates further. And it was a very, very wild trading day on Friday. We can see initially the markets rose, then they heard this news, the market plunged by about 1%, and then of course there was this miracle recovery by about 1.3%. But let's have a look at the more minute details of what Jerome Powell is really thinking and what's going to happen in the future. The speech resembled remarks Powell made last year at Jackson Hole, during which he warned that some pain was likely as the Fed continues its efforts to pull runaway inflation back down to its 2% goal. But a strong economy and decelerating inflation also gives the Fed room to proceed carefully at upcoming meetings. So Powell did say the lower monthly readings for core inflation in June and July were welcome, but 2 months of good data are only the beginning of what will take to build confidence that inflation is moving down substantially toward our goal, he said. That's exactly right, everyone. We've seen this time and time again over the past 2 years. It looks like inflation is falling only for it to spike back up again. And what I'm seeing with gas prices, with petrol prices around the world right now is they're starting to rise again. And I'm starting to see other goods prices increase as well. So I think Jerome Powell is actually doing the right thing here. He's not declaring victory on inflation, unlike what the Reserve Bank of Australia is doing. They're a complete disaster. We still have rampant inflation in Australia, but they're continuing to leave interest rates at just 4%, and that's why the Australian dollar is tanking. Doing too little could allow above target inflation to become entrenched and ultimately require monetary policy to wring more persistent inflation from the economy at a high cost to employment, he said. Doing too much could also do unnecessary harm to the economy. So all these people saying that Jerome Powell is going to create this magical, miracle fairy tale of a soft landing and everything's going to be okay, that is not going to happen. There has never been a rate hike cycle this fast, this aggressive, and every single rate hike cycle, there's always been 100% of the time a recession. And if they actually call it a recession, because remember we had that last year, but they said, you know what, we'll just change the definition of that. He said, as it often is the case, we're navigating by stars under cloudy skies. Very, very true. Now, markets have been pricing in little chance of another hike at September meeting for the Reserve Open Market Committee, but are pointing to about a 50-50 chance of a final increase at the November session. So it's going to be very, very interesting to see they do that, because if they do another rate increase, we're going to see more pain for the bond market and more pain for the banks right when their bank term funding facility is due to expire. Projections released in June showed that almost all FOMC officials saw another rate hike likely this year. And all the people in the stock market saying there's going to be cuts happening very, very soon, well, he gave no sign that they're even considering a rate cut. Now, I have been very surprised that the economy and the job market has been so resilient over the past 2 years with them lifting interest rates to 5.5%. But remember, this all has a lag effect from when interest rates hit their peak, and the Federal Reserve Chairman Jerome Powell admits that we haven't felt the full effects yet. So Powell also noted that previous tightening moves likely haven't made their way through the system yet, providing further caution for the future of the policy. Now, famed investor and former Treasury chief has come out and said the Fed probably needs at least one more rate increase, Summer warns, but he also gives some much needed insights here as well. So what is he warning about, everyone? Well, he's talking about the skyrocketing government debt and public debt that is ballooning out of control. And if we do enter another recession, they're not going to be able to give the monetary response that they could in the past. So look at this chart, everyone. We can see here, this was a global financial crisis. And how we can see since the COVID crisis, debt has absolutely skyrocketed from around 50% of GDP to 119%. But again, that's not all. Even if the Federal Reserve keeps interest rates where they are right now, remember, they're still doing quantitative tightening. That's where they sell assets from their balance sheet. And they've still got about $8 trillion worth of assets to dump on the markets right when the US Treasury is also adding supply because they need to take on more and more debt because the deficits are getting out of control. So even if the Federal Reserve doesn't do anything, we're going to see yields on bonds rise, and that flows into all credit markets. That's why we're seeing the 30-year mortgage rising right now. You're going to see car loans, personal loans, and credit cards continue to increase. The US Treasury said earlier this month it expects to borrow a net $1 trillion this quarter. So this is absolutely crazy, everyone. They're adding $1 trillion of debt every single quarter. Remember, this took hundreds and hundreds of years for the debt to hit 1 trillion. Now they're adding $1 trillion every quarter. This is completely unsustainable, and I expect more credit downgrades to come and yields continue to rise, with the prospects for increasing issuance of long-dated securities in the coming quarters. Summers highlighted that the increase in supply is occurring alongside the Fed's continuing shrinking of its own holdings of treasuries via its so-called quantitative tightening program. Now, what did I warn about in my previous videos? Other central banks are going to start dumping US treasuries as well because they need money to stimulate their economies. And who are the two biggest holders of US treasuries? Well, that's Japan and China. Another factor is the potential for diminished foreign demand for US government debt, he said, especially from Japan, which is now considering its own potential shift away from monetary easing. So this could be the perfect storm for the bond market. We have the Federal Reserve dumping treasuries. We have other central banks dumping treasuries. We have the US government increasing supply, and this is going to cause interest rates to absolutely skyrocket. Because look at this real world example of what's happening right now with the mortgage market. So look at this, everyone. Mortgage rates in the US jumped to 7.23%, highest since May 2001. Home buyers face the most unaffordable market in decades, and woefully low supply of listings keep purchase prices high. So what you have to know is the only thing keeping the housing market afloat right now is there's absolutely no supply in the market. So what's going to be the big catalyst for the housing market tanking is when we finally start to see the unemployment rate go up. Now, I definitely don't want to see this. It's going to be very painful, but there's simply no avoiding it. So once we see inventory rise, right now, the housing market is so unaffordable. And if you're an investor looking to invest in housing right now, well, it doesn't make sense at all because you're looking at huge negative cash flow. So again, even if the Federal Reserve doesn't keep on lifting interest rates, we could see if the 10-year US Treasury yield keeps rising, mortgage rates of 8% plus. So everyone, I know what you're thinking. Well, okay, what does all this economic jargon and finance news mean for you in simple terms? What this simply means is, everyone, people are still taking money out of the bank. The bank term funding facility expires in 6 months. They're going to have to give hundreds of billions of dollars or find that from somewhere to repay the Federal Reserve. We'll have to see if they extend it. The Federal Reserve has come out and warned, unlike the markets are hoping, there won't be any rate cuts coming soon. There's actually more likely to be more rate increases. At the same time, other central banks are going to dump US treasuries, US government bonds. The Federal Reserve is dumping bonds. The US government is creating more supply. What's simple economics, supply and demand. If there's not the demand there, there's huge amounts of supply coming onto the market. the bond market is going to tank. And remember, the bonds are what the banks sell to fund these deposit outflows. So this could create a vicious cycle and cause another financial crisis very, very soon. So everyone, how are you going to want to prepare and protect yourself? There's not financial advice. Just what I'm doing is I'm diversifying into gold and silver and Bitcoin as well, because like what we saw during the banking crisis, it was very surprising. Bitcoin actually surged because people wanted to get out of the traditional banking system. Now, in the short term, gold and silver will sell off along with the stock market, but when things really hit the fan, people will run to a flight to safety that gold and silver really is. But everyone, what do you think about all of this? Let me know down below. Now, for my loyal viewers and subscribers still watching, you're awesome. Thanks for watching. I'll see you all in the next video.